Thank you for standing by. This is the conference operator. Welcome to the Skeena Resources Eskay Financing Package conference call. As a reminder, all participants are in listen-only mode and the conference is being recorded. After the presentation, there will be an opportunity to ask questions. To join the question queue, you may press star, then 1 on your telephone keypad. Should you need assistance during the conference call, you may signal an operator by pressing star, then 0. I would now like to turn the conference over to Galina Melgar, VP of Investor Relations. Please go ahead.
Thank you, operator, and good afternoon. I'd like to welcome you to our project financing conference call and webcast. Before we get started, I would ask everyone to view slide 2 of the presentation of our cautionary language regarding forward-looking statements. Joining me on the call today, we have Walter Coles, Executive Chairman, Randy Reichert, President and CEO, Andrew MacRitchie, Chief Financial Officer, and other members of the executive team. Yesterday's news release details the highlights of the project financing for Eskay. You can find a copy of this news release and the slides to accompany this webcast on our website. After the prepared remarks, we will open up the call for Q&A. At that time, we will invite analysts to queue up for questions. And now, I'll turn it over to Executive Chairman Walter Coles.
Thanks, Galina. Appreciate everybody taking time from their day to join us for this call. I'll go right to the elephant in the room. The share price was down yesterday, which is frustrating and perplexing to us because we think what we've unveiled is an incredible financing package that is a massive de-risking milestone for the company and for the Eskay project. So we wanted to have this call and sort of go through the details and make sure everyone understands the nuances of the package. Let me start by just sort of recapping. It's a over $1 billion Canadian financing package, $750 million US dollars, all from a single entity, Orion Resource Partners. I'd also note that the amount of the financing package is substantially more than the initial CapEx that's defined in our feasibility study from just over 6 months ago, which was 713 million Canadian dollars. I'd also like to emphasize the bespoke nature of this financing package and that we're getting a significant amount of funding ahead of the final permit. So that's 100 million US of an equity commitment and then 200 million of stream commitment that's available to us in sort of an unusual fashion. I'd also add that we have not entered into any hedging or concentrate offtake agreements as part of this financing. So we've gone out of our way to make sure we're maintaining a commodity upside exposure with this package that we put together. There are 3 themes that flow through the entire package that I want to talk about. The first is certainty of funding. The second is flexibility for the company. And the third is optionality. So let me talk about each of those with regard to each component of the financing package. And I'll start with the equity investment. So Orion, as we announced in our press release, is committed to investing $100 million US dollars into equity in the company. We took 58 million of that and put it through a flow-through swap transaction, which netted the company $72 million on the other side of that at $8.32 per share. So it's 12 million shares issued at $8.32 a share. So, what's important about that is we took this $100 million commitment from Orion and we turned it into $114 million US proceeds. So, again, I think that's a pretty innovative aspect of this transaction. I will, add that we are committed to using that 100 million Canadian that we got out of the flow-through swap transaction on CapEx spending. Obviously, we have well north of that amount in our CapEx budget. So that was just a nifty way to take advantage of some tax incentives in Canada and get a little bit of extra funding. Secondarily, Orion made a direct investment into Skeena for $16.6 million US. That was 3.4 million shares at $6.65 per share. So in both the flow-through transaction and the direct investment, look, we got this done at a premium to market. I think relative to the market close yesterday, it was like a 6 or 7% premium. You know, to give you some context, in our last two experiences doing bank-led equity financings, our share price mysteriously drops in the 2 weeks before we launch a deal, you know, sometimes 10 or 20%. Then there's the, you know, typical 7 or 8% discount to market on the equity financing. And then, of course, there's usually the 10% underwriting fees to the banks. The beauty of this deal is we avoided all of that. Instead of raising equity at a discount to market, we got it done at a premium. And Orion is now our largest shareholder, currently at around 15.4%. There's still the balance that Orion has committed, $25 million US. You know, the reason I wanted to do this is because I'm hopeful that we can get our share price higher throughout the balance of the year. And so when we take in that additional money, it'll be less dilutive, and I expect Orion will remain well south of a 20% shareholder in the company. So, you know, what we got here was a certainty of funding. There were other financing proposals we had on the table. There were also north of $1 billion Canadian, but in each of those other financing proposals, they were contingent on us going to the broader markets and raising equity financing in the typical route. So the beauty of this equity component with Orion is we got 100% certainty on the equity. There was no contingency of going out to raise more equity elsewhere. So it really satisfied that first theme that we were looking for, was certainty of funding. One last thing I'd add is it also creates alignment. Like, it's rare that you have the lender, you know, if you go and raise money from a bank, the bank isn't also an equity holder. In this case, Orion is our largest shareholder in the company now. So think about that when you consider that Orion is also providing a stream and a debt facility. If there's anything in those packages that are detrimental to shareholders, guess what shareholder gets hurt the most? Guess who our biggest shareholder is? It's Orion, who's our lender. So keep that in mind as you're you know, evaluating this financing package. Let's move to the next aspect of the package, which is the gold stream. $200 million US gold stream. The condition precedent on the drawdown of that $200 million is the technical bulk sample permit, which we expect to receive later this summer, sort of end of August into September timeframe, and then we'll be able to draw that entire $200 million as part of the stream facility. Orion will end up with 10.5% of the payable gold that we produce. Keep in mind the gold represents about 2/3 of the economic value, and the silver component is about 1/3. So, you know, when you think about this in terms of the total metal value, the stream is actually closer to, like, I don't know, 6.5%, 7% of our metal value. But I do want to emphasize again that there's no silver included in the stream. Personally, I think that the supply-demand outlook for silver is extremely bullish, and so we wanted to maintain all our upside exposure to the silver price, and that's why no silver is included in the stream. There's also an ability by Skeena to buy back 2/3 of this stream at an 18% IRR 12 months after we start production. And this was a really powerful reason we decided to go with Orion. Most streaming companies don't seem to want to allow buybacks on their streams, and we wanted as much upside optionality as possible, so this ability to buy this back was extremely important. You know, I think we created kind of an asymmetric trade here, in that if the price of gold goes down, Orion gets a lower return on their investment via the stream. However, if the price of gold runs up, let's say price of gold goes from $2,300 to $3,000, then the beauty of our situation is Orion is capped at an 18% return on 2/3 of this, and Skeena shareholders get all the benefit, including Orion being a shareholder here. So it's an asymmetric situation, which I love. So just to you know, summarize, we're trying to maintain that optionality. And another very important aspect of this stream, it's the last bullet on the slide, the area of interest for the stream is constrained to 500 meters around the existing mineral reserves. So keep in mind that Skeena has 200,000 hectares of exploration land. We've also got SNP. We've also, got some other kind of interesting opportunities nearby. None of that is included in the stream. So typically, the way streaming companies make money is through the commodity price going up or the mine life being extended. And so we've constrained that upside potential for the streamer by drawing a circle around the existing reserves of 500 meters. So I think we really got what we wanted with this stream, and given the extremely high IRR on the project, I think at spot commodity prices, we're in the high 50s in terms of IRR. So obviously, it makes a lot of sense for us to buy back 2/3 of the stream at an 18% IRR. Like, it's still enormously accretive to the company. So you can see what we've achieved there is certainty of funding before permits, flexibility to buy back 2/3, and optionality on exploration and higher gold and silver prices. Moving to the last aspect of this project financing, the senior secured loan, $350 million US, and the cost overrun facility. The key thing to understand here is that there's no break fee. We pay a 1% standby fee to have $450 million US committed and available to the company, but at any point between now and drawing down any part of it, or even after we've drawn down some bits of it, we can change our mind and completely walk away from this aspect of the project financing. So what we wanted to achieve here, again, certainty of funding. So the money is there. We can say we have a fully funded project, but we have flexibility and optionality because we can walk away from this aspect of the project financing with zero penalty. If we find another form of financing that's less expensive or more attractive to us for whatever reason, we can replace this part of the financing without any penalties or fees. So I'm extremely happy with what we've achieved with this overall package for those three, achieving those three goals: certainty, flexibility, and optionality. And I think what we have is something that's fantastic for our shareholders and a major de-risking milestone. Since I have everybody on this call, I just thought I'd remind people of where our project NPV is, right now. If you look at the third box from the left, where we are on spot prices today, we've got a project NPV after tax of over 3 billion Canadian dollars, an IRR of 57%. Look at that third line there. Our after-tax payback on capital is 0.9 years. I had somebody else say to me before I launched into this project financing that we should use as much debt as possible given this super fast payback on capital. And truthfully, does it really matter if the interest rate is 11% or 13% or 14%? When you pay back you have an ability to pay back your loans and buy back 2/3 of your stream that fast? You don't see projects out there with an after-tax payback on capital of less than a year. And that, when you look at the free cash flow generation at spot, over the first 10 years, it's over 500 million Canadian dollars a year. But keep in mind that the grade of the deposit is much higher in the first couple of years. So I think our after-tax cash flow in year one might be around 800 million right now. So this is an amazing cash generating project with an amazing ability to pay down debt super fast. So I think that's reflected in Orion's willingness to provide a package of the size that we got from them. It's a testament to the incredible nature of this project. The other thing I would point out on this particular slide that I don't think most people realize is that Eskay is going to produce almost 8 million ounces of silver a year. So if you look down there, you see on the bottom of this slide, you see the 10-year average gold production, 260 million ounces, and then you see 7.6 million ounces of silver a year. Admittedly, we haven't done a very good job over the last 2 years of highlighting the incredible amount of silver that's going to be produced out of this mine. I think we're going to produce more silver than most public silver companies that are out there. And we're going to start trying to really make sure investors notice the difference in valuation for gold companies versus silver companies. I think we've been thrown in the bucket of gold-only company, and so we're going to really start to highlight the massive amount of silver that we're going to produce at Eskay. So before we flip to the next slide, just keep in mind that $3 billion after-tax NPV of where we are at spot prices today. When you jump to the next slide, the last slide here, we're looking at the infamous Lassonde curve, which is the typical evolution of a junior mining stock. You get the first run-up on the announcement of a discovery, and there's a lot of enthusiasm. No one knows how big the discovery is, so the stock keeps running. There's a lot of hype. And then once the discovery is drilled off and the company moves into engineering and permitting, you fall into this valley where Skeena has been. And you stay in this valley as you're working your way through your impact benefit agreement, your financing package. And then as you start to get through the valley, as you start construction and you start to move closer to cash flow, you move up the curve on the price to NAV ratio, meaning your market cap divided by your after-tax NPV. So keep in mind, Skeena's after-tax NPV at spot is $3 billion. Our market cap today is $500 million. That means that Skeena's price to NAV at spot is 0.2 times. So you can look at our peer companies here. These are other companies that are developing mines that are closer on their way through construction to cash flow, and you can see they're moving up that curve on the price to NAV basis. And we expect the same thing to happen to Skeena, and securing this financing package is a major milestone as we start to move up that curve. And that gives you an idea of what the upside is on the stock price from here. If we're trading at 0.2, or I guess if you use long-term consensus gold price 0.3, you can see that there's a multiple opportunity in terms of the return on the stock price. So it's never easy to get a mine constructed, built, fully permitted, but this is the reward as we go through these next couple milestones. Is an incredible return for our shareholders. So with that, I'd like to say thanks for everybody's attention to that, to me walking through these slides. And at this point, we'd open the call to any questions that you all may have.
Thank you. To join the question queue, you may press star then 1 on your telephone keypad. You will hear a tone acknowledging your request. If you're using a speakerphone, please pick up your handset before pressing any keys. To withdraw your question, please press star then 2. We will pause a moment as callers join the queue. The first question comes from John McNerma, private investor. Please go ahead.
Hi, everyone. Thank you for doing this call. I went through the press release yesterday, and it was quite a bit detailed, so I assume there were some important things to explain, so it's been a very helpful explanation. What I'd like to ask is to provide the interpretation I have of everything you've said and what was in the press release, and make sure that I'm understanding it properly. So my overall assessment here is that you've essentially rented this financing. And what I mean by that is you've taken any sort of uncertainty around an equity raise. You basically locked in the max amount of dilution without having to go to the market, number one. Number two, you've only locked in 1/3 of the streaming financing. And number three, you've got a debt facility that's repayable at any time with no break costs. So if I understand what you're saying properly, I think you've taken the potentially a slightly more debt cost in order to achieve certainty of equity financing, certainty of debt and stream financing, which, as far as I could tell, significantly reduces the risk of the project. This is still a development stage company. It's not through the permitting phase. Production won't start for another 3 years or so. So you've substantially de-risked the project in the meantime. The only real hurdle from a permitting perspective sounds like will be cleared up within the next couple of months. So you've accepted some modestly higher interest costs in exchange for certainty, optionality. And what I mean by optionality is the ability to refinance the balance sheet either as a standalone company or if the company was ever acquired by a larger company to enable them to refinance it and basically bring in their own cost of capital. So I just want to make sure I'm understanding things properly. Thank you.
I guess just high level, I would say yes, you are understanding things correctly. We did have another opportunity for a financing package that was north of $1 billion, but it didn't. It was much cheaper cost of capital, but it didn't give us the ability to walk away from so many aspects that we're able to in this package. So we paid a little bit more. We didn't go for the lowest cost of capital. We paid more to have the flexibility and to maintain optionality. And I think it was the right decision, and we now have a project that's fully funded. Thank you for your question. Operator, you can bring on the next person.
Once again, if you have a question, please press star, then 1. The next question comes from Philip Ayton, private investor. Please go ahead.
Hello, everyone. Thanks for taking my question. The question is more about CapEx and understanding. My understanding about the mining industry is that most mining companies run higher CapEx than their assumptions, and I wanted to understand how confident you are about your CapEx number, and if that CapEx number includes inflation going forward.
Yeah, thank you for that question. I'm going to ask Randy Reichert, who's President and CEO, to answer for me. Thank you. Randy?
Yeah, thanks, Walter. Inflation right now, concerns with it are very minor, to be honest. What we're seeing kind of is in some of the portions very minor. So to give you an idea, in the electrical high voltage gear, for instance, there's been some slight increases, but we're talking $500,000 on over $15 million of orders there. On some of the mill stuff that we've been doing, we're seeing we're actually under slightly on what we've done so far. So not so much. And we've got to remember that these are very recent numbers. So the numbers that went into our last DFS were done fall of 2024. So they're pretty recent still. What we're also seeing is maybe some of the pressure coming off. There's a lot of mining construction projects going on in Canada today. Some of those contractors are freeing up. Some of the people are freeing up there, so we're seeing a little bit better there as well. So overall, that we're very confident in the number overall, and going forward on it. In terms of inflation itself, no, we haven't modeled that into kind of the DFS CapEx, but on a continuing basis, we're updating our financial model. Does that answer your question?
Yes, it does. Thank you.
Yeah, I just add one more, I think, a tribute to this project is that we have a hydroelectric facility 17 kilometers away. And so, back when this project operated in the 1990s and 2000s, that hydroelectric facility didn't exist. So all of the energy component of the operating expense was coming from diesel or propane. So there was this exposure to the volatility of oil prices. Now with this new hydroelectric, I say new, it was built, I don't know, maybe 8 years ago, we were able to sign long-term contracts for electricity at very attractive pricing. I think it's around 5 cents per kilowatt hour, somewhere, give or take right around that. And so we're not going to be subjected to different quarters where if the price of oil were to run up to $200 a barrel, suddenly our energy cost explodes to 50% of OPEX. Now we're able to have a pretty steady forecast on what the energy component will be. So that's a big advantage for the Eskay operation. Operator, next question, please.
The next question comes from Miroslav Riba with Tectonic Advisory Partners. Please go ahead.
Good morning, good afternoon, guys. Walt, special congratulations to you, but also to your team, Randy and Andrew, who we've gotten to know over the years. I would like to sort of follow up with two things regarding your introductory remarks. So you mentioned that there were some other offers that the board considered, and you ended up partnering with Orion, because one could say this is a true partnership once billion-dollar numbers are involved and a multi-year time horizon. So what would you, in your words, what sort of won the bid for Orion versus some other opportunities you had, potentially more industry-driven players or different style of capital? So if you can just expand on that. And then secondly, the other thing you mentioned that I'm very glad you did is silver, because in the Western Hemisphere, we understand silver a little bit better than some others around Australia and some of these other finances that we follow. So it's not been particularly highlighted. Looking at Skeena over the past 12 months and looking at resource and upgrades and the plans, we didn't really speak about silver. So is that, in your view, a viable upside? And then how is that impacted with this financing, your silver upside? Do you have anything to say to that? Thank you.
Yeah, so let me answer the first part. Your question was why Orion versus some of the other options. The first reason is Orion provided a holistic solution to us. They provided the entire equity piece. They provided, also a stream and a debt facility. Historically, for a mine project, you would go to banks to get the lending. You would go to a streaming and royal company if you wanted to do a stream. And then, of course, you'd have to go to the equity markets. And it used to be you needed to raise 40% equity and 60% debt, just as a kind of a rule of thumb. So keep that in mind. We did $1 billion financing package, and the equity component is, in Canadian dollars, 140 million Canadian. So that's 14% versus the typical dilution of 40%. So, Orion's willingness to offer that to us is incredible. So, that was the biggest reason, was the one-stop shop for funding. And then the second reason was the flexibility that Orion was willing to offer us. And by that I meant the buyback on the stream, no break fees on the debt facility. And then the third thing that I loved, which is part of the one-stop shop, is the alignment of interest. Instead of like taking bank debt and the banks on one side of the table and we as equity holders are on the other, I find comfort in the idea that Orion is our biggest equity holder and is on our side of the table as well. So those were the three big reasons that we went with Orion. Now, to answer your question on the silver, you're exactly right. We haven't done a good enough job highlighting the silver component of Eskay Creek. It's something that we're going to make as a major priority over the next 12 months. And along those lines, we hired Galina as our new VP of Investor Relations. She came to us from a silver company, so she's got lots of experience in this topic, and we'll be working closely with her to really shine a spotlight on the fact that Eskay is going to do 8 million ounces of silver a year and be one of the largest silver mines in the world. So we obviously want to go after the premium, the price to NAV premium that the silver companies get versus the gold companies. So it just means more upside potential in our stock price. Thanks for your question.
Thank you.
Operator, there's another question.
The next question comes from Kate Nakagawa with CIBC. Please go ahead.
Oh, hi. Thanks for taking my question and congrats on completing this financing package. Just one question with regards to the permitting timeline. Are there any approvals you're expecting could potentially take longer than originally anticipated? Thanks.
Okay, the question is, are there any permits outstanding that we're expected to get that appear to be off track is basically your question, right? Am I understanding? Okay, so Naileen Morin is here. She's our VP of Sustainability and an expert on permitting in British Columbia. She joined Skeena from the Tahltan Central Government like a year and a half ago, and she was in charge of the lands department at the Tahltan Central Government, so she had enormous amounts of permitting experience as part of her role at the Tahltan Central Government. I'm going to ask her to give her views to, does it seem like any permits, are you worried about permits? I mean, it is BC, right? I'm joking about that, but look, you know, we've always thought it's not a question of if we'll get permits, it's always a question of when. So I'll ask Naileen to give us her views on how the permitting situation looks right now.
Thanks, Walter. We've been working quite closely with BC's MRC committee to ensure that we are sufficiently addressing permitting timelines, including any specific risks associated with timeline slippage. The other thing that's important to note is that we also work quite closely with BC to ensure that we're prioritizing things that, you know, the project needs, because it optimizes the resources on both sides of the table.
Okay.
And the final piece that I would add there as well for folks to consider is that we have established a strong and collaborative working relationship with the Tahltan Central Government that allows us to work closely with them on the development of these applications, taking into consideration their review to ensure that the application has their input before it's submitted to BC.
Yeah, I think that's a wonderful innovation that you've come up with, and it's a really important aspect to keeping our permitting timelines intact. And so we'll be looking forward to the technical bulk sample permit coming in again, sort of into the summer, early fall, and then the next big milestone after that will be the environmental assessment certificate, which currently is expected at some point next summer. So thank you for your question.
Great.
Operator, I think at this point our time is probably is up, but I'll turn it over to you if there's any, or can I take it? Okay, I'll take it from here. So look, I just want to say thanks to everyone for giving us your time this afternoon. Just to recap, this project financing package gives us three really important things: certainty of funding, flexibility for Skeena, and optionality for higher metal prices and exploration. I appreciate you all joining the call with our team today. If you have any follow-up questions, please don't hesitate to reach out to us. Thank you.
This concludes today's conference call. You may disconnect your lines. Thank you for participating and have a pleasant day.